Afternoon, everybody. My name is Andy, and we are very pleased to have this event to share about financial options for your business and also how to network because for the business owners. We are also thankful for PIF for sponsoring this space for us. And our speakers today will be four of them. 𝗶𝘃𝗲𝗿𝗆, Dr. Jeremy Loh from Genesis Ventures, and two PIF chiefs they will be sharing. Dr. Grace and also Jonathan. So we will have a lot of learning and we have a small panel for you to ask questions. Okay, so for those online, welcome for joining us. And we'll be going through the different presentations shortly. This event is organized by ourselves, IES 𝗶𝗃𝗲, together with 𝗍𝗃𝗍. So 𝗍𝗃𝗍 is the National Body for Entrepreneurship. So 𝗍𝗃𝗍 and 𝗶𝗃𝗲 work closely together. We will often impact areas, but 𝗍𝗃𝗍 look after entrepreneurship for all industries for Singapore, supporting anybody who wants to be an entrepreneur through training, through networking, through fundraising. So let's do the 𝗍𝗃𝗍 part of it first. So 𝗍𝗃 stands for Action Community for Entrepreneurship. So they've gone through a recent rebranding. They have started off from part of a government ministry, and since then they have become privatized. So they will be supported by government quite a bit in the past. Okay, so their mission is to advocate for startups, for entrepreneurs to capitalize activities in innovation and collaboration, and also build capacity and capability to use resources to engage in entrepreneurship activity. Okay, so these are current board members. The current chairman is Mr. James Tan, who runs Quest Ventures, which is a VC fund. Then we have various corporate and so government people supporting 𝗍𝗃𝗍, helping to be able to grow the entrepreneurship ecosystem. So there are 5 pillars. Startups is one. They focus a lot on public sector. They also help to link to government agencies for bridging the needs of the community as well as bring opportunities from government sector. Corporations, they work closely with them to source problem statements, opportunities. Risk capital, very important, right? You need money to run any business. So they have a pool of investors as well, angel VCs to help to match to the entrepreneurs. Lastly, they also support IHLs, universities, polys, even secondary schools to plant seeds for entrepreneurship so that they can grow their pool of entrepreneurs who want to start from young, give them an interest in the entrepreneurship. Okay, so they also have programs like fundraise to match startups with investors. You need to be a member of 𝗍𝗃𝗍 to participate. So that's one of the reasons you should join 𝗍𝗃𝗍 as well. 𝗍𝗃𝗍 membership, currently there is a $200 per year. You can join as a membership. You can have access to collaboration opportunities, priority access to events. If you are interested to join, I will be sending that to all the participants. You can certainly contact our 𝗍𝗃𝗍 person, Kevin Neo, which unfortunately not here today, but you will be able to address your interest in joining or in any of the activities. So this is the 𝗍𝗃𝗍 context. You can follow all these slides will be given to you, so not to worry. You can follow their social media or their LinkedIn. You can post all the activities, both in events in local, also they do help companies go overseas, things like that, fundraising. So that's all about 𝗍𝗃𝗍𝗍. We will move on to the next part. Introduce IES 𝗶𝗃𝗍𝗍. My organization is an extension of the Institution of Engineers Singapore, which is the national body for engineers, and it's been around since 1966. Our role is really to support engineers and the growth of the engineering profession, and to represent engineers in Singapore, so internationally. So my organization extends from IES into IES 𝗶𝗃𝗍𝗍, which stands for IES Incubator and Accelerator. Our role is really to support entrepreneurs who want to build their business. As you know, engineers are very good at solving problems, creating solutions, but to build a business, they really need a lot of business training, guidance, fundraising. So we are there to help them. Okay. So that's our mission: support science, technology, engineering ventures, doing translation, selling to market, And in doing so, we hope that we can have a very vibrant engineering and venture community that can really transform life through innovation and technology they bring to market. Okay. So where we start off is we focus on engineers and IES members, corporate SME spin-off, IHL spin-off, and we provide them engineering transition support. So they may have a prototype, MVP, they're trying to scale up, go into mass manufacturing, we can help them. Then we provide mentorship and also business support training and fundraising, connecting them to investors, business network and overseas markets. Yeah. We also look out for corporate SME problem statements because engineers, love to solve problems, right? So we put this in front of them, tell them, these are some opportunities you can build solutions around. So corporate SME problem statements, we look out for them. Industry problem statements, innovation opportunities, we regularly share it with our database of innovators. This is what we do. Companies that have their customer discovery validation and they're ready to scale up, we help them with their business structuring, planning, and also fundraising. And then they exit our program when they have enough, have a good plan and the fund raised. So they continue to execute and give them to the next stage. So this one. So in terms of technology areas, we focus on infrastructure technology, which is really building related materials, processes and facilities management, IoT for industrial purpose and smart cities, robotics automation, and fintech sustainability. So these are our focus areas. So companies who are trying to scale up in this business areas, we can help them through our innovation acceleration. These are some of our partners that we work with, Enterprise Singapore, IPI, A-Star, universities, and also industry organization, venture funds, and also 𝗍𝗃𝗏𝗏, which is the Institute of Singapore Chartered Accountants, which is the equivalent of IES in the accounting and CFO space. We also work with them. So from our IES members, 𝗍𝗃𝗏𝗏 members, and our network of angel and VC, we form an investor network that has an interest to invest. So every quarter, we bring them to our pitch day where they meet our QAPs, try to match for fundraising. Okay. Yeah. So new programs that we did in 2023, we actually do corporate innovation as well. We want to support bigger engineering companies who want to innovate. We have 3 consultants to help them. Yeah. So we're trying to go up to SME, large corporates, even MNC, they need help and support them. And then the other area we want to work on is overseas expansion. Every tell you Singapore market is very small with 5 million people. Singapore companies really need to look at the bigger market. Southeast Asia, where there's 600 million people. Malaysia has 20 million, Indonesia has 200 million. So these are all the big markets we can help to connect through our market mentors who are familiar with doing business there and guide the companies to those markets. Okay. These are our 3 corporate innovation consultants. We have Min, who's from Crux Asia. We have 𝗄𝗵𝗶𝗵𝗵, from 𝘆cie, and lastly, we have Randall from Infinite-use. Yeah, so they are trained in different areas: digital transformation, innovation management, and also tech commercialization to grow through innovation. Okay. So that's a brief introduction of IES in car. And yeah, that's my contact. I will send it to you. You can connect to me. Yeah. So now we move on to the next part of our presentation. Okay, we will do a quick introduction about PI.
Everybody coming to PI on this. As on just introduce quickly. We'll play a video, 2 videos to tell you what PI is all about.
PIF is a leading capital resource platform that supports entrepreneurs in raising capital and business development. Through the years, PIF has helped many entrepreneurs to raise their level of capital wisdom and entrepreneurship, steering them to the peak of success in their business. PIF's Group CEO, 𝗏𝗏𝗏𝗏𝗏, is a capital guru to many entrepreneurs and also a winner of Singapore Prestige Brand Award and Singapore Asia Pacific Entrepreneur Award. Jonathan has more than 20 years of experience as a serial entrepreneur. PIF has 4 subsidiaries companies to provide one-stop capital solutions. PIF Capital Center is a one-stop capital resource platform that raises the capital wisdom of entrepreneurs and lead companies to have better profits and value to build A-plus companies. PIF Capital Advisory comprised of a group of professional corporate finance experts that supports entrepreneurs in corporate restructuring and raising capital to guide entrepreneurs in the delivery of bankable business models to achieve business transformation and growth. PIF Global Capital connects entrepreneurs to angels investors, venture capital, and private equity investment firms, upgrading companies' business models, facilitating companies in raising capital, steering them towards IPO. Since 2012, PIF has helped more than 600 entrepreneurs and investors to realize their businesses to greater success. Let us come together in helping you reach the highest potential in your business. PIF Capital. We aspire to be the global leading capital resource platform.
As an entrepreneur for 20 years, I fully understand all challenges faced by SME business owners. SME entrepreneurs only know how to borrow money for their business because there are always lack of funding in how to grow or expand their business. But top companies, including startups in Silicon Valley, know how to use equity funding to start and expand their businesses. PIF Capital is founded because we want to empower all entrepreneurs to build A-plus companies, how to design a bankable business, raise and use capital so that they can grow their business into the international markets. We have a dream to build Singapore to become Asia's Silicon Valley so that we can support more SME to be successful. So if you are an SME business owner, join PIF Capital in building Asia's Silicon Valley.
Hey everybody, so we have Dr. Grace, who will be our first speaker from 𝗠𝗏𝗏 Capital. So let's welcome Grace.
Hello everyone. Thank you very much. Okay, so let me maybe introduce myself. Okay, I'm from finance background, graduate from 𝗍𝑎𝑐𝑡𝑎, and I just completed my PhD only early this year. Okay, so I've been all along in finance area. So I moved from finance to corporate finance in the last 10 years. Okay, why? Because when I'm in finance, okay, I also help, I partner with Jonathan in business. And I realized that, in doing business, okay, whether you're a big SME or you're a smaller SME, everyone are facing the challenges of what? Finding capital. That's why you're all here, right? What is today's title? Financing options. Am I right? So we are all trying to find ways. Okay, why is it that to find capital is so important? Because capital determines how fast and how big our business can be. Okay or not? Every single idea that you have, do you need capital to realize it? If you want to make profits, do you need capital? Every single thing you need capital. But it's not about whether you have money or don't have money. If you got big dreams, you need even more capital, right? Nothing to do with whether you have money. Okay? So every single business owner are finding capital. Because this is very important. But business, as a business owner, we focus on the wrong thing. When we're focusing a lot on what? Generating profits. Not forgetting that when you need to generate a dollar of profits, you need what? Probably 20 cents or 30 cents of what? Capital. If you got no capital, you will not be able to generate any profits. So that is the importance of capital. And to find capital is very important. There are many ways for you to find capital. Okay, what are the ways? Let's explore. First, how many of you have started your own business with your own money? Have a show of hand. Majority of us will do that, right? We will first, when we want to start a business, we need capital, we'll dig into our pocket, right? So after our pocket is dry up, what do? If our pocket is not deep enough, our pocket is a little bit shallow. Okay, after using up all our savings, what's the next way of finding capital? What's our second financing option? Sorry? Huh? Loan sharks. Not yet. Not yet. You will come to that. But not at this stage. Not so fast. Am I right? The second way of financing option is what? From the 3F. Who are your 3F? Who are your 3F?
Friends.
Yes, it's your family, right? Either you borrow from your father, mother, brother, sister, or whosoever, your wife or your husband, right? Hopefully not from your children, right? Yeah. Then family. Next, you borrow money from what? Your friends. And then the third one, what's the third F? What's the third F? Fools. No lah, it's your fans. It's your fans, it's those that admire you, right? So after you realize, after a while, when you try to get your financing option from these three group of people, after a while you find that you got no friends really. Your family members also don't want to come family gathering with you. Why? They see you what? Can borrow some money. You must believe in me. My business share can make it what? It's just that now I haven't made it. Right? You're repeating the same story again because you constantly need capital. Right? So you realize that you also exhaust your 3F. No matter how well, they adore you as your fancy. They will also and what is the third way of finding capital? This one, I think yes, whether it's from loan shark or from what? Legal institution, banks, right? You get money. So, but can you tell me, do bank lend money to the rich or to the poor? Huh? Daniel, bank lend money to rich or poor? To the rich, If you got profits, you can make it, not about assets, right? So all the bank, what? First thing first, they want to assess you, right? So you're already so poor already. You still want to get money from the bank? No way. Unless you find Daniel. He can cover a little bit for you, right? Yeah, so it's the way, okay? It's your financing option for you to what? To grow your capital. And this is what I call what? Limited. That's why your company is called what? Private limited. Because you've got limited ways of finding capital. That's why your business growth will be limited because the capital determines how fast and how big your business can be. If your ways of finding capital is so limited, you become a private limited. You cannot become a public limited. So what are the ways to tap into unlimited capital? We need to learn. Okay. So besides debt financing, you need to learn another financing called equity financing. I'm not saying that debt is no good. Debt in the short run, it may be difficult for you. It may seem that you need to pay interest and you need to repay principals, right? It may seem very expensive for you in the short run, okay? But it is cheaper in the long run, especially if your business is profitable. If you are a profitable business, you want to go into debt financing. But what if you are a startup? You got no credibility to borrow money from banks. You have exhausted all your 3F. You have also dig into your pockets. You got no choice. You exhausted all this. What must you do? The only way you have is what? To sell your shares. So equity financing is what? Is to sell shares. Okay. The most powerful assets of a business owner, okay, is what? Is the shares that they own. Once you start up a company, you will have 100% shares. Okay, the power of equity is what we need to explore. Okay, because this is the what? This is the open secrets of all the Fortune 500s. Do you know of this company called Grab? Do you know of this company called Grab? So Anthony Tan, is his business making money? Yes or no? Is Grab making money? It's not, right? Probably you are making more money than him. Your business may make $1. As long as you make $1 profit a year, you're better than him. Because his company is what? Losing what? $1 billion a year. You make. Why is he staying in a good class bungalow? Why? Because he knows the power of what? Equity financing. All the Fortune 500s, the majority of the founder uses equity financing for them to tap into the unlimited capital market. In the capital market, this one, every time you just sell your shares, okay, and you can price your own shares as long as you are able to convince the market, right? As long as you have a growth story. It is something that haven't happened. This one, you will be looking at your what? Your past and your present. This one, what will you be looking at? Future. Something that has not happened. When something that has not happened, is it got more leverage for you to craft your own story? Right? So this is the power of equity, because the power of using equity financing, you are able to what? To craft out a story, you are able to sell your future. We are not selling about the past, we are not selling about the present, we are selling about the future. And this is the open secret for all the Fortune 500. Because 99% of Fortune 500, okay, they are listed companies. Except probably one that is very well known called Huawei, right? Other than that, does Huawei sell shares? Does Huawei sell shares? Yes, it does. It sells shares not to the public, but it sells shares to who? The employee. Have you heard that 99% of Huawei are owned by its employee? Have you heard that? Why are they so driven? Okay. So why are they so driven? Why are they so united? The power of equity. Because have you heard of employee share option scheme? Have you? Right. So Huawei also sells shares. It's just that it doesn't sell to the public. But because of some political reason, but it sells its shares to what? Its employee. Yeah. But the rest of us, if we want unlimited capital, if we want unlimited financing options for our business, we must also know equity financing. Another, this is very well known. Everybody know how to borrow money from the bank already. Okay, to borrow a little bit more, then you need to find Daniel. Other than that, every one of you are well versed in debt financing. Am I right? Yeah, but sorry.
Still learning.
Still learning. Okay, can learn from Daniel how to borrow 20% more or 30% more from the banks. Yeah, this we still need to learn. So I'm not advocating that this is more powerful than this or this is more powerful. I'm saying as a finance person, okay, we need to weigh the balance. The ratio of how much you should use for your debt financing and how much you should use equity financing. Because like I said, debt financing may seem like a little bit more expensive in current terms, but it's cheaper definitely in the long run. And especially when your company is making money, this is cheaper option. If it's possible, we try not to use this. But if you are a startup, if you are very small, struggling to grow, okay, and you need unlimited capital and you cannot borrow any money from the bank. Once Daniel said, I cannot help you already, then you can find Dr. Grace. Okay, I can help you with this. Okay, this is another source of financing for me. Okay, and okay, so who do you find? When you want to tap into this unlimited capital market, right? You need to find investor. Okay, so equity financing is about finding investors. Okay, and what are the types of investors? Who can you go and find them to invest? These are all the type of investors. First, you need to find accredited investor, not any Tom, Dick, Harry. You may find your friend. I know it's very common that a lot of us will just have a drink over coffee, share our idea, and we are able to get, 30, 50K or even 100K from a single investor. But in Singapore, under the MAS regulations, you can only get investment from accredited investor. What do we mean by accredited investor? They probably have assets of more than $5 million, not including your property. Okay, or they are making at least 300,000 a year. Okay, reporting tax. Okay, and these are the people that you can get money from them. Individual. So individual accredited investors are what we call angel investors. So there's a lot of angel investors here in Singapore that if you know how to get money from them, if you know how to share with them, sell them your whole story, they are here to invest in you. Okay, usually these are still the 3F. Okay, it's just that when you approach them, okay, instead of saying that I pay you interest and pay you what? Pay you back your principal. Okay, and you pay them based on what? Not dividends. You pay them based on the capital appreciation. One good thing about equity financing is what? I just do a comparison. I'm not trying to overshadow. So then don't get angry with me. So I'm just telling you for debt financing, okay, you need to pay interest plus pay back the principal, right? For equity financing, you don't have to pay interest. Do you have to pay back the principal? Yes or no? Make a guess. I won't penalize you for answering wrong. But if you don't answer, okay, you are so quiet, right? Let me play a game. Okay, so if you don't answer, you buy us everyone the Starbucks, and including those online plus my team, can or not? But if you answer wrongly, you won't be penalized. Okay, so again, I ask, if you If you go into debt financing, you need to pay interest, you need to pay back your principal, am I right? But for equity financing, you don't have to pay interest. Do you need to pay back your principal? Yes or no? Thank you very much. Only when I say I must be like Singapore government, right? A minister fine, then everybody will start to answer, right? If there's no Starbucks, nobody answer, right? The answer, you all say, generally, you all say no, right? You all are what? Robbers, take people's money, don't need to pay, huh? You all take people's money, don't need to pay,
Give them share.
Give them share, then how to pay? You need to pay. It's just that you pay in a different manner. You see, when you are using debt financing, you pay $1 for $1, right? On top of the interest, right? You use cash to pay. And you're right. For equity financing, you use shares to pay. And when you issue shares, the beauty is not only it will not affect your cash flow, you pay them the shares, they take your shares, go where? To cash out. Where do they cash out? Stock exchange. Stock exchange is actually a marketplace for them to sell shares, right? So you're paying back the capital using other people's money. So another simple business language for equity financing is learn how to scam. That's our language here in PIF. We every day say OPM, OPM. Learn how to use other people's money. You issue shares, they take your shares, go to a stock exchange and sell and take back their what? Their capital or their principal without hurting your cash flow. That is the beauty. Unlimited. You pay, but you pay through other people's money again. You take other people's money, you use other people's money to pay back. So that's why we advocate a lot on using equity financing. Okay, so you can find an angel investor to invest in any of your friends around you. Okay, or you can find VC. For those who are very deep in tech or in technology, you easily can find what? Venture capital. So these are the people that are more long-term. Okay, they can wait for you 5 to 10 years, no problem. Okay, but because of the long ROI, okay, the long ROI, they will then give what? They will give you a very cheap valuation. They will buy you very cheap. They will buy your shares very cheap. And usually a lot of people are stuck with this. Because once they start, they don't have anything, right? They will start to what? Dilute 30-40% again, right? Straight away. And after a while, they feel that what? They have sold themselves away. The founder feel that they have sold themselves away because diluting too much, right? So venture capitalists, they are more long-term. Okay. So then next, private equity. So what's the difference between private equity and capital venturists? They both give you money. But for private equity, they are looking at more short-term, more mature SME. Okay, that means your business is almost to the what? Near to the goal pole of IPO or a trade sale. Then they will come in. They will only come in to scale up your business. These will come in to kickstart your business. This is coming in to what? Scale up business. So when you're not ready, okay, please don't go and find them. You will find that you face too many rejection until you give up selling shares because you find the wrong person. If you're just starting up, please go and find VC. So you must learn how to find the right what? The right type of investor for yourself. Last but not least, investment banker. Okay, when do you find investment banker? When do you find them? Just a year before your what? Your IPO. Usually they will only come in at what? Pre-IPO stage. Usually, okay, they are the nearest to the what? IPO host. Okay, and because they come in at different stage. Okay, in investment you must remember this thing called R&R. What does R&R mean?
Rest and recreation.
Rest and relax. So when you want to go for equity financing, you just have to take care of this two R&R. It's not rest and relax. It's not rest and recreation. Number one, the first R is called ROI. What's the return? If they give you $1, can you give them $5 back? That sounds what? Not bad. Okay, this is the first R. The second R is what? Risk. Okay, so risk is measured by what? Okay. Besides the geographical risk, the political risk, okay, harming is also an issue. How fast can you return them their return? So the highest risk taker is what? Angel. They usually are your what? Fancy, the 3M, right? Then followed by DC, because they can wait for you 10 years. Then followed by PE. So the highest risk taker are the one on top. The investment banker don't take so much risk. Only when you can make it, you are already there, then they come in. They will usually come in at your pre-I stage. Yeah. And they expect about 30 to 50% discount from your IPO price. Meaning to say, if your IPO is $1, they will only buy your shares at 50 cents. So they make the other 50 cents once you IPO. This is the standard market rates, okay, for a pre-IPO. Okay. So any questions about that? So this is my financing options using equity. Okay. And I think the next speaker will tell you, okay, how do you, once you go into this equity financing option, he will share with you how do you use other people's money to pay other people's money. Okay, how do you exit? Okay, how do you let the investor exit from the investment? Okay, and it is also a very good way for you yourself as a business owner to exit from your business, because after all, we are human, right? Okay, our business are artificial individuals. They don't have to retire, but we need to retire. So when we retire, what happens to our business? What will happen to your business? Have you ever thought? When you retire, what will happen? So, not so fast. We are all very selfish. We want to pass down to our second generation. Am I right? We hope that our second generation will take over. But it's because of this expectation, it also costs our relationship. Because we always think that we are better than our children, right? So if you cannot pass down to your own second generation, or you will never find anyone in your company that you can pass down also. Even if you can find, they don't want. You get what I mean? So passing down is difficult, but doesn't mean that it cannot be done. The destiny of your business, have you ever thought? Tonight, okay, if you can, give it a thought before you sleep. Okay, what will happen to your business when you retire? I mean, some of you still look very young, you still got a lot of time to think, but it's always better to plan ahead, okay? Yeah, so for those that are not so young anymore, you better tonight think, you don't think tomorrow night, okay? Only the young ones can think after that, okay? So the destiny is either you pass on, right? You pass down to the second generation. If not, you sell away, like what 𝗲𝘃 say, right? You sell, but no one want to buy because you want to sell high, they want to buy low. Do you know how to price your business? Do you know how to justify the price of your business? So usually trade sale is also very difficult, okay? Unless you get a professional in to help you facilitate, okay? Third destiny will be what? Corporatizing your business and let it go IPO, right? The fourth one will be what? The fourth option is not what I hope you all will end up with, which is to close it down. Because you cannot sell, you cannot pass it down, you dare not go IPO, so you close down. Okay, I don't hope you be a murderer of your own business by closing your business down. So be a responsible entrepreneur. Even if you are ready to close it down because you have made enough, but what about those, your colleagues in your company? They may not be ready to retire like you. Okay, so give it a thought, give it a serious thought tonight. Okay, so maybe I shall end here. Yes, thank you very much.
Is there a market practice or what's a norm in terms of share?
This one, is there a standard, a percentage that you can sell, right?
Yes.
There is no. There is no. But here in PIF, we have a system to tell them we usually start with 10 to 20, not more than 20. Not more than 20. Okay, this is what PIF teaches us. So don't have, but don't sell anything above 20 because why? Especially if you need to keep on doing fundraising, you will find that you'll be diluted too much. Very fast, your value finish more than 51% already. How you determine the price? Can I sell for you here? You must come to PIF. Okay, and learn. They have 6 simple steps. Okay. Including designing your growth story, how you re-engineer, design your business model from feasible to bankable. Next, after you design your business model, we will give you a way, okay, we call that financial roadmap. Okay, we will teach you a template, okay, 3 to 5 years, how do you calculate your valuation? We literally teach, in the past, I will be the one doing for you, but I will be charging you very high. But the next speaker are the ones that you all should learn. Okay, because he don't want to charge you high, he wants to teach you and then you all DIY yourself. So I got no business. Yeah. So yeah, so the second step is we will give you an Excel spreadsheet where you can do your own calculation of your valuation. Yeah. Then after that, we'll give you a template, okay, for you to put everything together into a pitch deck. Everything DIY. There's a system, 6 steps. After that, then go to do roadshow. Different people, okay, how do you talk to them? 见人讲人话. Yeah, this one I say on. I must have my image. I only say 见人讲人话. That's all. We will also guide you how to talk to these people because you have 知己知彼，百战百胜, right? So you need to know their appetite. What is their R? What is their R&R? So we have to put everything in the pitch deck. Then we go and see them. Okay, get yourself prepared. Always get yourself prepared before you make your first step. Okay, to see these people. Don't waste your resource. So there are 6 steps. Yeah, you can go PIF. Every Tuesday they got this IPO square where you can learn all this. Yeah.
Okay, thank you.
Thank you.
Now we have Jonathan who will share with us about IPO and give an introduction. Later we have time to ask questions. So,
okay, ladies and gentlemen, okay, I'm an IPO freak. Yes, there are not many IPO freaks around. How many IPO freaks are there? That means you like your company to go IPO, you like IPO, have a show of hands. Okay, ladies and gentlemen, okay, if you are not a IPO freak, okay, it is very difficult for you to raise funds from equity financing. Because there are only 2 ways of financing. One, you debt, you borrow money. The other one is what? Okay, equity financing. That means you sell your share, raise capital. So, if you are not an IPO freak, then how are you going to sell your shares? So you must love IPO first. Because why? That is the best exit strategy that's the best exit for your investors. So always put yourself, okay, put ourselves in the shoes of the what? The investor. The investor say, if I buy your shares, what is next? Correct or not? You say 5 years later, 3 years later, or 1 year later, my company will get IPO. Do you follow? So if you are a capital entrepreneur, okay, you will be able to understand what the investor wants. Because the investor do not want to buy the shares of a private limited company. You follow? Okay? But of course, you will tell me, say that no IPO, I can sell away my company. Correct? But again, okay, again, as you can see, that if you sell, okay, if you sell IPO, on the way you do IPO, you sell away, can also can. Correct or not? So you need to plug one of the target, sell away or IPO. But of course, the IPO selling partner is a better target for the customer because you can tell the customer, if you don't IPO, I can sell away. Right? So of course, this capital entrepreneur is the one that knows how to sell his equity. Because hopefully most of us in the tech business do not want to just go onto the borrowing. Because you see, there are hundreds of tech entrepreneurs in front of us. Okay, how Jack Ma raised equity finance, $5 million. Okay, in 1999. Okay, when he started, and in year 2000, while his revenue was still only 0, he can raise another 20 million. Okay, based on 66 million valuation. 66 million valuation. And look at Mark Zuckerberg. He was able to raise equity finance of $5 million US, even when he was in his Harvard University. So, okay, all this case study in front has shown us that if you know how to sell an IPO plan for the investors, then then you got chance to raise capital from equity. And there are hundreds of case study out there showing that equity financing, okay, leading you from where you are now to what? To IPO. So IPO, when you are when you are very confident about IPO, how can you be confident about IPO when you don't understand? So my proposal for you is learn about IPO. Because if you learn about IPO, you understand about IPO, then you use that as a common target between yourself and the Your direction and your investor direction is the same. Then, okay, believe your company will go IPO. Correct. In that way, you increase your chances, you get very good chance of raising capital for your business. Because why? Borrowing money not easy, right? Because finding capital need two ways. Borrow money, sell shares. Correct? Borrow money, sell shares. But borrow money, you need collateral. Correct? You need collateral. How much money can you earn? So as what Guru Grace says, or Dr. Grace says, okay, this can give you unlimited capital. Unlimited. Yes. Okay, Sing Song raised 126 million in his IPO. You know, AB&B raised 1 billion during his IPO. And Jack Ma break world record 20 billion US in the IPO. So IPO can raise the most money of capital. But okay, for us in PIF, we focus mainly on a lot on what? Angel investors. Because why? Because okay, because we handle a lot of SME. A lot of SME out there, they're not like you, tech, so that you can get money from the VCs and the PE. But you see, VCs, when they invest money in you, you know, they want to buy as low price. When you understand about your business, when you understand about IPO, you can sell at a better pricing. So we propose that, you know, you get some good capital even through angel funding. Because personally, I have raised more than $3 million in equity financing, just through equity financing. Because my business is not an easy business. You know, I also need capital. I also sell capital. So we are the same. We are also in the business that need equity and that need capital, correct? So those who need capital, have a show of hands. They need capital, have a show of hands. Well, the rest never put our hand. All don't need capital one. Huh? Those don't need capital, have a show of hands. No matter what I say, also one put our hand, one put our hand. So you see, we are here to find out how we can raise capital, correct? Then, who are you? Are you a conventional entrepreneur where you focus on, building profits for a company? Or you see, in the tech business, if you are talking about tech business, you must be very good at building the valuation of a company. Yeah, not just profit, not just thinking of making profit. Because when your company has valuation, okay, like Anthony Tan, even in 2020, okay, though his company was, running, burning rate of 100 million a month, he can go and buy good cash bungalow. Because why? His company got valuation. So building company valuation, is very important. Yeah, and sometimes building company valuation got a lot of, it's about how good you are in presenting your business, your pitching. Yeah, and the best pitch is that how you pitch your company going IPO. From there, then we will go back to the basic, how to design our growth story. How sexy is your growth story? Because if your growth story is not sexy enough, you got no chance for IPO. Yeah, as long as your growth story is sexy enough, and plus you are a very good pitcher, you can convince the investor. But use what? IPO story. So I'm an IPO freak. I come here to share you. Okay. Have a good target for your investor and yourself. Okay, sell the IPO story. Then we can get a good story. So for us, PIF is a platform where we promote IPO through our events, our training and consultancy. Okay, so we help entrepreneurs to prepare the IPO preparation works. Okay, so that's the only page. That's the only slide I have. Okay, so if you are a conventional entrepreneur, your mindset, okay, your mindset is not ready to go into equity finance. Okay, once you go into equity finance, okay, you got to switch to become this. You got to switch about what the target, what is next. Okay, so I think selling IPO target, okay, is one of the best way that you can do it, or it's the best way to do it. Okay, so Alvin, you see, Alvin has come and attend quite a few of our events. You know, he's also in the robotic business, in the tech business. He also feel that, you know, when I ask who is the IPO fee, he put out the hand. So if you want to learn more about IPO, okay, I welcome you to join our event. So can we show them our IPO stuff? So we have our regular IPO talk, why, when, who, what, how of IPO. Every week we have a half a day event, just 3 to 4 hours to talk about. So I can invite you to come and attend, because this IPO Square, we call it IPO Square. Why IPO Square? You see, usually people will plan for only what? One IPO plan. But in PIF, we plan for you 2 IPO. So it's a 2 IPO strategy. But why 2 IPO? Because we believe that, okay, we are the anti-unicorn, concept. Because the unicorn concept is that you must grow to $1 billion, then you release, correct? You must be like Grab. You must be $1 billion, then you can release. But the thing is that, ladies and gentlemen, okay, on the way while we do our fundraising, seed funding, round A, round B, round C, round and so on, it's very tough. Okay, I would rather that if we can raise money from angels, okay, we can do our first IPO already. Because nowadays even small companies can raise. Yeah, last December 2022, okay, there are 2 companies. There was a small company that got public listed in Singapore. Okay, so give a guess what the sales revenue. Then you give a guess.
10 million.
Okay, these 2 companies are about only 5 to 6 million sales. Ladies and gentlemen, 5 to 6 million sales is small company. Agree or not? It is small company. How many of you here got 5 million sales running restaurant? Huh? Don't have. Got 3 million restaurant. 2 million restaurant. Huh? Usually, your tax cover, the revenue is not that high yet. Never mind. You see, in Singapore context, 100 million and below we consider medium size. 10 million and below consider small. But I'm sure you all agree with me that 5 to 6 million is still considered small company, right? Small. But the first company, LMS. Okay, LMS is a Penang company, it's a Malaysian company. The sales revenue was only about 5 to 6 million. The second company is called Moontalk. Okay, it's in the event business. LMS is in don't know what lab test testing business. And then this Moontalk is in the event business, about 5 to 6 million. Okay, and Moontalk, guess what? What's the profit like? Let's give a guess. Is it 1 million, 2 million, or 3 million? Anybody got answer? You know what's the profit?
No, the company.
22,000. 22,000. So a company with 22,000 profit, is it a very small company? Agree or not? Agree or not? 22,000, a real profit. But the valuation, 43 million. 43 million, that's 2,000 times PE. Yeah. So I think this guy, 𝗲𝗵𝗶𝗰𝗵 is also an IPO figure. So in Singapore SGX listing, there is no profit requirement. You follow. There's only one requirement. What's the requirement? That you can convince the investor to invest. That's all. So, ladies and gentlemen, how to convince the investor to invest in you? Okay, I would advise you to learn about what? Learn about IPO. Because as long as you learn about IPO, okay, even your small company can reach. So the world changed already. It used to be only the medium or precise company can reach, right? Now small company can reach. Okay, I share with you this year. I also have a friend who got listed in Nasdaq. Okay, I think the company is being called 𝗍𝗶𝗵𝗵. Yeah, who heard about this company 𝗍𝗶𝗵𝗵? Don't have, Okay. I think the valuation is 40 something million US dollar. Okay, give a guess what's the revenue. If you guess, need to guess. Zero. Yes. So just now I say 5-6 million, you'll say okay, it's you don't have 5 million. Never mind, zero lah. Yeah, you can go Google 𝗍𝗵𝗵𝗵. Okay, got listed this year. So Peter Chu was the IPO king of Singapore. Peter Chu, you can Google Singapore IPO king. Peter Chu, CHOO. He has done 200 IPO. You understand? So why can Peter Chu list his company with zero revenue? Because he was the IPO king. He understands that IPO, okay, it's not what you think. You follow? I need to have a lot of revenue. I need to have, I need to have a lot of profit. I need to be very big. Correct or not? Zero revenue also can list. Okay, 22,000 profit also can list. Correct or not? What you need to do? You need to know how to sell your shares in the, in the equity market. You know how to get into the capital market. That's all. So I hope that in your pursuit of your business, you do not just be a technical man. Because a lot of tech people are very technical oriented. How many of you here are very tech oriented? Wow. How many of you here are very business oriented? How many of you here, whatever I say, also don't put out your hand? Whatever I say, also don't put out your hand. So you see, okay, I'm not a technical person because I'm a salesman. I started knocking on door. I'm a salesman. Do you follow? Because I understand that by if I know how to sell shares, I can get the public. Do you follow? That's all. So only when the investor is convinced that you can lead your company to public listing, okay, they want to invest in. Yeah, because only companies that have able to have show their growth story, blah blah blah, you can sell a share. Right now, if I invest 50,000, 100,000, or I have 500,000, then my money can be the public stock. Okay, you follow? They find reason to invest in you follow? Okay, so ladies and gentlemen, let me assure you that if you have the capability to convince the investor that your company can go on the track of IPO, you got a much better chance to raise capital. Yeah, because you have so many people out there, so it's not an easy path selling shares to raise capital. I understand because Bill Gates 90% of investors turning down. Yeah, Bill Gates 90% of investors turning down. Okay, Howard, Starbucks, this founder, 90% of investors turning down. Yeah, it's not easy. So we are on track on this fundraising road. It's not easy. Yeah, but okay, nevertheless, okay, all the more we have to learn. We must master the art of equity financing. We can learn more about IPO. So I welcome all of us to come. So this is the IPO. Okay, about why list your company. When is the best time? Where are your IPO team members? What are the options, the different types of IPO, as well as how to increase your valuation. So especially for tech business, you don't really need a lot of revenue or even profit. Some you can even go for spec listing. Who that was spec listing the show? Spec. I think you are on the tech business now. Because are you aware that even with zero revenue, you can list to spec? Heard of it or not? Zero revenue can list to spec and insurance. Oh, never hear.
So far, never hear zero revenue can list to spec.
Yeah. There's one EV company that lists a zero revenue. One EV company, not many like. But if there's one case study, you can number two. I'm not suggesting that zero revenue go like. But of course, what I'm trying to tell you is the mindset. Yes, how you are convincing your investor to invest. So you can use IPO as a good way. So we are promoting this IPO here almost every day. My job every day of my life is promote IPO. Because I will be the next IPO king. So I tell Peter Chu, say you do 200, I'm going to do 300. I want to overtake him. I mean, I've invited Peter Chu to come for IPO talk a few times. I always wanted to recruit him as my poster boy. 200 IPO. But I think we focus mainly more on IPO preparation rather than the IPO. Because I always tell my my students, the IPO preparation is 10 times, 50 times, 100 times more important than the actual IPO. Because the actual IPO doing all the professionals can do it, right? Right. All the lawyer or people are all out there, they're all doing it. But the actual IPO preparation, how many people are in this business? In Singapore, only one. My company is. You try to find another one that focus on, they have a team of 20 men that focus on IPO preparation, you cannot find. You cannot find. So I'm very sure we are the only one, because so far we don't have a direct competitor. So if you want to your business to go into fast track growth, learn about what? IPO. Oh, thank you very much. Yeah.
Now we have Dr. Jeremy Loh to share with you about venture debt. Yeah. From this.
So first of all, thanks to Andy and IES and also PIF for inviting me to give a talk about Genesis and venture debt. Okay. But I also must apologize that I go right after this because I have another event and run. But let me introduce myself first. My name is Jeremy Loh. I am a co-founder and managing partner of Genesis Ventures. We are a venture debt fund, right? So I think a lot of you, none of you may have heard about venture debt before. It's a very new concept. It's also a very new asset class as well. I think Grace mentioned a little bit about SME owners liking debt financing a lot to grow the business. Okay, so I'm on the other extreme of the industry. Every company and borrower that we work with are startup companies, right? They only know how to raise equity, and they unfortunately don't know how to raise debt. And it's also a problem in the industry, right? Because they don't get access to debt financing from us, right? The traditional banks don't really lend to startup companies. But in recent years, in the last 7 or 8 years, right, actually banks have been starting to get into venture debt, which means that they are lending companies that are actually lost. Okay, so the industry is changing. But this whole concept of venture debt, right, has been around for actually 20 to 30 years. Okay, there's a very famous bank that just failed in March this year. It's called Silicon Valley Bank. Okay, the market cap is tremendous. Their loan book is amazing. Okay, but they failed not because of venture debt, but they failed because of the bad equity stuff that's actually risk management. Okay, so interestingly for IES and Andy, when he presented, actually engineers are very good technologies, but very poor. Okay, and there's a reason why I turned from engineering into finance. And when I jumped into finance, right, actually it got me very intrigued. Okay, I joined a venture capital fund here called 𝗵𝗵 Investment. So that's the investment arm of the Singapore Economic Board. At the time, the fund actually managed about $5-6 billion of capital, investing in high growth technology companies all across. Right, so we invest in companies in the US, we invest in companies in Europe, in Israel, as well as in China, and then more recently in Southeast Asia as well. Okay, so that's how I got myself into the venture and the startup world. Okay. And as an investor, we see both sides of both good equity financing and also the ability of these startup companies, right, to be able to raise debt in person. Right. So even when they have very little revenues and they are loss-making, they were able to get access to debt capital because their business model requires capital. Okay, the one thing that startup entrepreneurs do not realize is that their business resembles very similar to how a small and medium enterprise business is all across. Okay, when you first start up, you raise equity money because it's a big capital that's designed to allow you to disrupt the market, right? So whether it's Grab, who's disrupting the taxi market, Food Panda, who's disrupting the delivery and food business as well. But once you start to grow and scale up that business, right, then you want to start relying on some part of debt financing to be able to help you scale as well. Right. So myself and Genesis, as well as our next speaker, firstly with 𝗄𝗵𝗶𝗵𝗏, right, are in the business of actually providing debt to a group of companies that's not very well taken care of by the traditional banking. Okay, so what is Genesis? We started in 2018. Okay, I left DBS Bank after helping them set up their venture debt business. And DBS in 2015 decided that they wanted to get into this business of replicating what Silicon Valley banks have done very well in the US, right? Which is trying to promote and provide debt financing for startup companies. And DBS was actually seeing the emergence of these startup companies in this part. Okay, a lot of the SME owners have been kind of retiring and not renewing their business. And then there's this new group of companies that emerge, right? And equity investors come in, put a lot of money in them, and then turn into a unicorn, go public, or get a trade sale. But the banks actually are not participating in this industry. Right? So DBS saw this trend, wanted to be part of this whole new ecosystem as well. And they built a new business unit within the small and medium enterprise banking group that takes care of startup and provide them with debt financing. So I came in with my venture equity investing experience to build up that unit there. And after about 4 or 5 years, I saw this opportunity that was really moving. And there was an opportunity for me to be able to start up my own fund as well. So that's how Genesis Alternative Ventures was born in 2015. We went out to the market to try and not just convince the entrepreneurs to pick up debt financing, right? From Grace and for what Jonathan is saying, the startup owners love equity, right? They love to raise lots of equity, they love to spend lots of equity, and then after they're done with that, they raise more equity as well, right? So they're not exposed to the fact that actually that is very dilutive to their cap table, right? And once they started realizing that actually there's a lot of working capital requirements that can be financed by debt, okay? That's how that mindset shift started from. Okay, so in 2018, we launched Genesis Alternative Ventures as a venture capital fund specializing in debt, right? So we provide debt for companies that's already been VC sponsored, right? So if you have gotten money from a venture capital fund, you're growing your business, you have some revenues, your product is well loved by consumers and business who pay for them, but you're still not making and cannot get loan from the banking industry. That's where we come in, right? So we come in to serve a gap that is actually vacated by the traditional banking industry, and hopefully we can, over time, once the company has grown to a sizable revenue and scale, they can then go to the bank and say, I've already proven myself to be able to understand and use that to grow my business. Then the bank can actually come in to give them loans, right? Actually a lot more cheaper. So we raised the first fund in 2018 of about $75 million. We've invested that in debt of about 25 companies. And then last year in August, we actually launched our second fund. So we are still in the process of actually raising fund 2 for Genesis Alternative Ventures. We are targeting to raise anything between $120 million and $150 million. And we are continuing to invest in the startup industry here all across Southeast Asia. Okay, so what makes Genesis a unique venture lender is that we are targeting unique companies within Southeast Asia. Silicon Valley Bank, if you have heard of them before, we are actually very focused on US, Europe. We tried to enter China and India, but it wasn't very successful. Okay, so in essence, what is venture debt, right? So venture debt is very similar to a bank. Okay, that means that you are taking a loan to finance the scale up and the working capital requirements of your company, which is typically a tech or tech-enabled, right? The one thing that we don't do is we don't go after the traditional SME industry. Okay, the guys that the banks are already well served. Right? So in Singapore, there's 3 local banks plus a host of other foreign banks as well, and they provide a lot of working capital requirements to SMEs. Okay, so they are really very well served by the bank. We come in, provide venture debt for group companies that the banks doesn't serve. And essentially what they do is that they borrow money on top of the equity that they raise, right? And what do we get in return, right? We get 2 things. We get 1, the principal and the interest repayment, right? That's what Jonathan and Chris have mentioned. And number 2, we get what we call an equity sweetening, right? So we get a small portion of the equity option in the company, and that equity option allows us to buy the shares of the company at a pre-agreed price, right? Why would we do that? Because if we were charged the true risk appetite, right, of the company using interest rate, right, we will probably have to go into the 24% range, right, which is a credit card low charge rate, so to speak, right? And that's not something that a typical company would be able to afford, right? But by splitting it into 2 different halves, right, one part is the side, and then the other part is the equity option. And if they do well, right, they eventually got bought out by someone through an M&A, or they go through the IPO option, then the equity option for Genesis will become very profitable part of the business. Okay, so hopefully that's given you a flavor of what Genesis is. That's given you a little bit of insights of what venture debt is. If you guys have any questions, I can maybe take a few questions here. If you don't have, then I have to go. Anyone has any questions?
How often is it being exercised?
It's a very important part of the whole fund return. Right? So when we look at the entire fund return, and the investors in our funds are, like, for example, banks, there are family offices as well. So when they look at the total returns of investing in a fund, right, it's both the interest rate, which is typically higher than what the commercial banks are charging. So if the bank charged, let's say 5 to 6%, we'll typically charge 10 to 12%, right? Then the equity option part is something that's very interesting. So if the company is quite successful, if we go through several rounds of financing, the valuation goes up by 3 to 5 times. That's where we can reach the additional alpha returns in, right? But also, I think it's important to understand the risk, right? Because some of these startups may fail. But of course, we are also coming in at a time when the company is a little bit less risky, right? The risk is not on the product side, but the risk is on the execution side.
Yeah, the questions, if you can take 1 or 2,
Yeah.
we let Dr. Jeremy. Yes. What's the expectation of the percentage that will actually converted by the
Yeah, so when we look and assess a company, right, we want to exercise every equity option that we take under the company, right? We are very selective in giving out that. Right? So if there's 100 startup companies that come to us in a year, we will typically only do about 10%. Right? So we don't have a large balance sheet like bank. But if we were to move towards that direction, let's say in the next 5 to 10 years, and we look at the aspirations of being a Silicon Valley bank in Singapore, right, then we would be able to do a lot more. Okay. But when I say that the fund returns comprise of both the interest rate as well as the equity option, we have every aspiration to exercise that option as well. Okay. So then the question would be, why would you pay an interest rate and give up an equity option at the same time? Okay, because when you compare venture debt, you compare venture debt against venture equity. Okay, if I give you a simple example, if you raise $1 million in equity versus raising $1 million in venture debt, right? If you raise $1 million in equity, you might have to give away 10% of the company. Okay, but if you raise venture debt, the equity option will probably represent less than 1% of the company. Okay, so net you save about 9%. But of course, that 9% saving, you replace it with interest repayment, right? So that's the difference as well.
Maybe just one last question is, what type of company or stages characteristics best in this question?
So number one, like I said, we don't go for traditional SMEs, right? So if it's 100% owner founder owned, right? That's not something else. We don't do traditional industries, right? So, if you're precision manufacturing, if you're doing, let's say, events management, that's not something for us. We go for companies that are tech or tech, right? So, for example, a company that we have funded in Malaysia does drone services for the agriculture, right? Another one is a company that actually uses lasers to provide 5 or 6G connection, right? Without having to dig the ground to lay fiber optics. Okay. Another condition for us is the VC sponsor, right? So there has to be a venture capital and an institutional investor on camping. And by that, we don't mean an angel investor. We mean somebody like a 𝗿𝗶𝗴𝗵𝗁 or market, somebody like that. So a proper fund, their license, their 𝗃𝗵𝗶𝗵𝗁 structures. So these are the primary conditions. We don't provide debt financing to early stage companies in the seed or Series A. Typically, Series B, right? We have given that to companies that have, let's say, as low as $1 to $10 million of revenue, all the way to $100 million, right? And one of our companies actually within 18 months of the taking venture debt actually listed on Nasdaq, right? And they have about maybe, let's say, $100 million, right? So with the interest repayment, with the Nasdaq listing, and we convert our equity option, that becomes a very profitable loan for us, lending business for us. So we're hoping to look for companies in this whole region as well. And we've done today about 30 to 40 companies, right? We are still a small fund. We'll be managing about close to $200 million. But we're looking for companies that have this DNA, that's an aspiration to grow, wants to take a little bit of less equity and less dilution, and use efficient debt capital scale. It can be loss-making, and in the last 3 to 5 years, actually, most of the companies have loss-making. But in the last 24 months, miraculously, most of them have tried to become profitable. Some of them are already profitable. So we are seeing, I think this whole equity winter is so following the investment market. VCs have actually pulled back the investment valuations, keep coming down. This whole reset of the industry is actually good, right? Because Southeast Asia founders and entrepreneurs have become too used to actually raising equity as stream, right? They spend the money, and once they spend the money, they can actually go back to the market and raise it. But now, because there's a lack of capital, the entrepreneurs also have become a lot more prudent in how they spend. They've turned their company into sustainable growth, and they become profitable.
Okay, thank you, Jeremy.
Thank you, Sherry. Thank you, everyone.
We'll have the next speaker first, but we have a video to run first. Can we run the video first?
Do you have an opportunity to take your business further and need growth capital to make it happen? 𝗃𝗵𝗶𝗵 helps e-commerce brands like yours grow with capital that's fast, flexible, and founder-friendly. Say hello to revenue-based financing. With 𝗃𝗵𝗶𝗵's revenue-based financing, you enjoy a flat fee. Say goodbye to complex interest rates and drawdown fees. You also enjoy flexible repayment that moves with your business. How? By sharing a percentage of future revenue to pay down your funding amount, it lessens pressure on your business during slow months and speeds up your repayment on high revenue months. The best part? Repayment is done automatically through your sales channels. That's one less thing to worry about, so you can focus on your business instead of admin work. Say goodbye to conventional funding hassles and hello to revenue-based financing. Grow now, pay later.
Hey, thank you for that video. Yeah, I heard about 𝗃𝗵𝗶𝗵 actually many years ago, but first time I meet 𝗍𝗶𝗆, a founder of this company. Maybe as you share about 𝗃𝗵𝗶𝗵, also share about yourself.
Okay, good afternoon, everyone. Thank you for staying till almost evening time for this. My name is 𝗍𝗶𝗆. I've been doing my own startup and businesses since 2008, 2009. I have done brick and mortar business, restaurant, cafe. I've done e-commerce, having my own direct-to-consumer brands. I have done marketplaces, online marketplaces for used cars as well. I've done a lot of different gigs. However, the biggest pain point for this new economy business which mark up more than 80% of the economy now, it's very difficult to go to a bank to get a loan because you don't have 5, 10, 20 years of operating history. You don't have hard assets to pledge against for you to get lending. And when you go to a VC or private equity or equity investor, right? Your business is not something where they value at 10, 20, 30x. So it's very difficult to get money from them as well. So my co-founder and myself, we started looking for alternative financing from our previous experience because we needed money to grow. So hence revenue-based financing, hence 𝗄𝗵𝗶𝗵𝗏. So what is revenue-based financing? It's actually very simple. It's a debt product. However, it behaves like an equity. Our goals and your goals are aligned. So I'll give an example. Traditional bank loan, you borrow, let's say 100K from a bank. You have to pay basic principal and interest no matter how your business performs, right? When you're going through a really tough time, you still have to pay the bank. However, for revenue-based financing, we take a percentage of your sales every month, which means on a low month, because this is a seasonality, on a low month, you pay us back a smaller amount. So it gives you less pressure on your cash flow. And when you have less pressure on your cash flow, you can run your business better. So the goal, the interest for you and us are aligned. So this is the fundamental of revenue-based financing. And why is it called revenue-based? So the criteria is, as long as you have recurring revenue, we can take a look at your company and we can look at your data and we can start giving you a financing amount. So this is revenue-based financing. We're very, very flexible. We work with other types of lenders as well. So for Genesis, Jeremy just now, we have the same clients as well, because business is very dynamic. We have different needs at different times. So we don't try to, take the whole market, but instead we work with everyone. We work with other lenders to find the best solution for your company to help you to grow. So our mentality is, hey, if we can help you to grow, you can pay us back faster. So there are two parts of business. The first part is obviously the revenue-based financing. We provide you capital, right? But the second part is our growth solution. So for example, if you let's say if you're an e-com seller, selling shirts, selling cell phone cases, or selling some service, a SaaS platform, right? You want to expand to another country, because we are already plugged into all your sales channel, such as Amazon, Shopee, Lazada, Shopify, WooCommerce. We got your data. We can analyze your company for you, and then we do a health check for your company and say, hey, why is your conversion rate so low? Why is your shopping cart abandonment rate so high? We can help you to diagnose your business and give you a suggestion. And on top of that, when you need help to grow overseas, we already work with a lot of ecosystem partners, such as banks, such as Clubsec, such as media, like advertising agencies and fulfillment companies to help you to kickstart the business at one go. So you don't have to worry about finding your own way in a new country, in a new market. So we do all this on top of giving you financing. We don't charge you for that because it goes hand in hand. As your company grow, as you make more money, you repay us in a faster manner and a safer manner as well. So this is us in a nutshell. I mean, I can dive into a lot about tech, and our tech is basically, B2B financing. I'm sure you guys have done it before. It's very cumbersome. You go to a bank, you go to a private credit lender, it might take months, email each other, a lot of documents, you ask a lot of questions, 1 round, 2 round, 3 round could take months, right? But for us, we try to streamline the whole process to our customers within 7 days. So we do it with leverage on data. So for example, if you're selling on Shopee, Lazada, even on TikTok or your Shopee or your own website, right? We plug into your sales channel so we can pull your data right away. And this action is done automatically, and we can come up with a term sheet for you almost quite immediately based on this. Of course, we still have a credit process to come back with some qualitative Q&A, but this whole process takes about a week, and then we'll know whether we can fund you or how much we can fund you. So this is our the tech stack that we've built. On the other part is nobody likes to get chased for payback, right? So you borrow from a bank, it doesn't feel good that every 30 days say, hey, you owe us this amount, you need to pay us this amount. So we try to do it a bit more seamlessly, a bit more automated. But we work with other big tech companies like Stripe, Airwallex, Google, and other payment companies as well. So the repayment process is done automatically through your revenue source, which means we take a little bit from your sales. So if you're selling a t-shirt on your website for $100, we'll take $5, $6 off that sales towards the repayment. So we don't charge an interest, we charge a flat fee. So if we give you $100, say we charge you 10%, so you just have to pay us back 110. That's it. Now, how long does it take to repay this 110? It really depends on how fast your business grows. So we'll take the sales, a percentage of your sales daily, towards repayment to fill this $110. So, and hence, this process is automated, and hence the borrower doesn't feel as heavy. After 30 days, you have to pay a big lump sum. So we try to make our customer feel comfortable. We try to help our customer to grow at the same time. And this is, we believe it's a very holistic approach when it comes to B2B financing. You can't just give money and expect people to do well and pay you back. Our approach is, hey, we give you the capital that you need. At the same time, we provide growth solutions, we provide you with support. And obviously, our tech infrastructure at the back facilitate the ease of funding and the ease of financing and repayment. So this is us. Yeah, feel free to ask any questions. Yeah.
So for example, like if you have a company that say maybe you build a customer, build the customer twice a year.
Yeah.
So in that kind of scenario,
Right.
then working with 𝗄𝗏 is not going to be beneficial, right? Because you basically every time you get billed, you take a big chunk off.
Yes.
So that kind of case is better to go for factoring.
Yes, that will be better. We do have factoring counterparts, partners that we can refer as well. We have a huge network of that. We're not trying to take everyone's business, In fact, we're trying to grow the ecosystem. It's a big pie. So for us, the best type of customers are if you have a digital footprint, number one. Number two is if you have recurring revenue. As long as you have recurring revenue, it's a lot easier for us to give you a facility. Yeah.
So you're telling that project based shouldn't come to you?
No, it's a bit harder for a project base. Yes.
Thank you, firstly, for that very topic. So in summary, the target customers sounds like e-commerce will be perfect, right?
E-commerce, we have actually done brick and mortar business as well, like coffee chain or retailers as well, because we work with POS systems. As long as we're plugged into the POS system, we can track their sales. We can get a first cut of the revenue source. So we're not just restricted to e-commerce. Of course, e-commerce is our ideal customers, but revenue-based financing, it's the implication and application is very, very broad. It can be applied to many types of business as long as it's recurring revenue.
See, how is RBF different from merchant cash?
Okay, merchant cash advance. Essentially, merchant cash advance is the earlier stage, like of RBF. It's somewhat similar. However, for RBF, for us, we ingrain a lot of data analytics into that as well. Merchant cash advance could be really just offline, historical. We are more forward-looking. We project the sales. We project your future receivables, your future revenue source, and give you based on your future. So we're a bit more forward-looking. Yeah. And we take a look at, and revenue-based financing is not something new. It has been around for around 10 years, and probably more. And the revenue-based financing companies in the West, in Europe, in China, in India, they're all unicorn status. So there's a huge demand. However, in Southeast Asia, there hasn't been a dominant player yet. So it's something new here. And finally, after we started for about 5 years, so we have done enough market education. Now we believe it's the time where we start growing together significantly with our customers.
So based on the model that you mentioned, it's basically two things, right? One is you already have ongoing revenue.
Yes.
So the best is like POS where you can actually track.
Yeah.
Then the second portion is they will actually prefer, just to mitigate, for example, some months are high, some months are low revenue.
Yes.
But I can see the bank doing the same thing for them. Why would they want to do it?
Okay. No, great question. Banks are very risk averse to come up with a new product. So RBF is a new product. So for banks to come up with any type of new product, it's going to take years. And the customer segment that we are servicing and targeting are mostly e-commerce, digital commerce, SaaS platform, and even some tech startups. These are companies that banks don't feel comfortable doing credit underwriting. However, we work with certain banks regionally as well to help facilitate, to mitigate their risks, and also to help them to understand how does the behavior of this new, because these are considered the newer type of merchants, digital merchants, right? The new economy businesses. Banks are still very risk averse, where they prefer like a 30-year-old business, 20-year-old business, or the big tech companies where one ticket, they lend out like what, 500 million. But for us, we're servicing, okay, so we do finance anything from $50K USD all the way to $1 million USD right now. So that is our mandate for now. And it could change over time as well, depending on the appetite of the market and customer.
Yeah, I have not really started borrowing from banks, but apparently the few banks that are aggressively going after SME.
Right.
So like frankly at this point of time, even though we have not really grown, right? The banks coming us every week calling, say, we want to renew money.
Yeah.
Now, the banks, my understanding is if your revenues are not stable, they look at whole year's revenues, so you get 3 million, and they base on the 3 million. So that was the reason I was looking at it and said, why would we want to go instead of moving to a bank? Because it's like if the bank is giving you 6%, you want to be giving 3%.
No,
yeah,
more for sure.
So it's really I still haven't seen, for example, what kind of situation somebody want to go to.
Right. No, good question. So for example, right, because most of our target audience are e-commerce, or even for the coffee franchise that we funded to further expansion. So let's say I use the brick and mortar example or e-commerce, right? When they want to do more business, let's say the revenue is 100K a month. Let's say they do around 1 million, 1.2 million a year. For them to hit 2 million, 3 million, what do they need? They probably need more money to do ad spend on Google, on Facebook, right? This is the first thing. And when you spend more on, and this could be very, very costly. It could take up to 30% of their, revenue, right? Then when they spend on the ad, they need to spend more on inventory, and they need money to do that. If they have no inventory, they can sell, they can get money back, right? Then after that, when you have more inventory, you need to hire more people for OpEx. But being an e-commerce, no matter how big or small you are, if you go to a bank, very, very unlikely a bank will lend to a e-commerce, because to them, it's a virtual business. Okay, this is one example. That's why we work with a lot of different marketplaces, and our pipeline, it's actually more than we can chew on. We need a lot, so we need more bullets to deploy to them. And this is good and bad, right? So let's say another example, the coffee chain that we funded is Tim Hortons. They actually went public in China. They're under a big RBI group in the US. They needed some funding to expand they want to open 5 more shops. This is in the Philippines to expand, right? When they want to expand to 5 more shops, because we already have data through their POS, through their other channels, their payment gateway and their sales channels, to see that existing 20, 30 shops, so we can kind of predict if they have 5 more shops, how much they extra going to make. So if they go to a bank, it might take 3 months, 5 months before they get approved. Number one. Then number two, if they look for a family office, if they go look for a private investor, they want to take 10%, 20% of their equity. So to them, there's no brainer to come to us. And we finance them in a very short frame of time for expansion. And they don't lose on equity. They get to open that 4 or 5 shops and everyone is happy. Yeah.
So you basically your customers are more niche.
Yes and no. Depending on what you say. I mean, now the digital economy is probably one of the biggest economy in today's society, right? And we surface them. I mean, Shopify alone, which is not even a very big marketplace, has 2 million merchants on it. I mean, Lazada, Shopee, Amazon, there's like tens of millions of merchants on it. And so it's actually a huge pie for us to serve. Yeah.
Thank you.
No, you're welcome.
Thank you for the questions. Any other questions? Maybe I'll ask 𝗶𝗶, are you the only RBF company in Asia or in Singapore?
No, there are actually quite a few. So we're not the only one. In fact, we hope there are more RBF companies in the region because, like I said, the pie is so big, right? But every RBF company, RBF is a very broad term. Every RBF company has their own mandate. Some prefers only certain type of customers. Some can do so there's not much conflict to, in my opinion, with that. Yeah.
It's a big market.
It's a big market. Yeah.
Good. Thank you. Sorry. Somebody's asking. Can you repeat the question?
I have a question. For IES income,
Yes.
basically my understanding is you're supporting startups. So there are quite a lot of okay, maybe I say there are more than one such organization that supports startup. So what is so different for IES income compared to the other startup? Meaning why are you different in terms of the way you support startup?
Right. Okay. So for IES focus on engineering companies in our space. So those 4 areas: environment, IoT, technology, process automation, and sustainability. And generally, it's led by engineers. We're trying to focus on engineers.
All startup is led by engineers.
Not all.
And a lot of technology.
We won't focus on fintech, for example, or tech and all that. We focus on companies that are trying to build hardware, software integration solutions, things like that. Actually, where we set up is because we see government has invested a lot into research. There's a lot of technology created. Engineers who understand technology, we are trying to match them to pick up some of this technology and commercialize them into companies. So we are trying to facilitate the process of become from engineers to become technopreneurs, essentially. So our unique point is that IES has a network of 7,000 engineers and coming from government sector, private sector, academia. So that's our network. And we talk to everybody. We are not just like NUS. We really see what the company needs. We have a program that is not batch-based. It's really, what do you need? You need a finance mentor to sort out your investment side, your pitch deck. You need more connections in this particular sector. We use our mentors to guide them. If you want to go to Vietnam, we can give you a Vietnam mentor who will help you enter the market successfully. So that's how we.
So that means basically is your focus on tech startup other than financial. And secondly is you have more flexible in terms of customized kind of support.
Yes.
Whether you need a capital, you need expansion,
Yes. Capital everybody needs, but
how
you build your business plan is important. How you build a business plan is important. We focus on engineers because we know engineers can build can create solutions. But often they fall is they don't know how to raise the fund, don't know how to sell effectively. So we have all these courses as well as mentors to guide them. Any other question? We have the two experts here on the IPO. If you have anybody has a question for them, please do ask. Now we can wrap up the video.
What do you think is the earliest that company should start?
Earliest, today lah. Start today. Why wait?
Any prerequisite?
Yeah, you need a sexy story. So you must design. As long as a sexy story, you start today, you start your equity financing. You can, correct now, you have a sexy story, you start selling your IPO. But of course, your IPO can be in 3 to 5 years time now. You cannot, but you have to start the first step on the track. Come and learn.
Is that course or what is IPO Square?
IPO Square is a half-day event where we talk about the why, when, who, what, how about IPO. Yeah, it's a half-day event. We have that every Tuesday. Yeah, you can find more from our email. You can send them some info. Then, yeah, it's a half-day event. I think learn is good. So then we have more IPO freaks.
I think because we talk a lot about how to fundraise, how to get more capital, but a lot of us has neglected that, you need an exit plan as well. Yeah, so when we need money, we just take, but a lot of us did not plan for the exit. So IPO is a way where you can plan for an exit for yourself as entrepreneur, okay, where you corporatize your business. At the same time, you also design an exit for your investor. So before you get an investor, I think to be a responsible fundraiser, you need to show clarity to your investor, how they enter and how they exit. So IPO is probably one of the exit that you can design. And in order to give them this exit, you yourself must know what is all this exit about. Yeah, so it's important that you know now. This is one of the options. Besides the trade sale.
Maybe this is Andy. How do you see PIF as a competitor or a complementary?
I help me grow bigger so that they reach the IPO stages. Yeah, we focus on the scale-up stage. So companies come to us, right? Usually they have MVP, they have some customers. But when they need to scale up, right? Let's say they build 10, 20 units of hardware and they want to build thousands of high reality. That takes a lot of engineering work and preparation to guide them how to manufacture, yeah. And maybe need capital, so IPO is one way, or fundraising. Any of the solutions like we have discussed about funding, right? Of them. Yeah. But important, you must have a plan. Okay, they need help with building a factory, they need help in getting to the market. This is where we help them. We're not a fund ourselves. We are more of getting the fundamental and the foundation right for the business so that they can use the funds and expand from there.
Okay. So maybe I just share.
Yeah.
That's why I asked that question. They also fund us. Okay. The way I see it for PIF is when you actually want to go an IPO or you need to raise fund, okay, they will actually hand over you. These are steps, these are metrics, these are the forms to fill so that you can basically take this and go and do it. I may be wrong because I do not know much about it. But that could be more like incubation where you start to feel the community, start to network people. Maybe like that's where you net the spark, say I want to go IPO. But you can't do it there because nobody will tell you how to do it. You have mentors, comes in half an hour and then leave. And then you're worse off because before you make clear, after half an hour, you're totally confused. So maybe the way I see is it's more like a community. You learn a lot more. But if you really want to go IPO, then that's why I see the experts. It's not complementary.
Yeah, we are all at different stages of the journey.
Correct.
Thank you, Erwin. Thank you.
Yeah, I think to add on, there is no competitors to us because we always practice what we call C to C. from competition to collaboration.
But you cannot see that way,
that is our responsibility, right? Yeah, I think majority of us do not want to compete with each other.
Yeah.
Okay. If there's a chance to collaborate, why not, right? Yeah, and especially in Asia. So I think in PIF and I share the same visions that we want to build Asia Silicon Valley. And to build Asia Silicon Valley, it cannot be done by one company alone. It's the whole industry, it's the whole nation, it's the whole region. Okay, because Asia is a region. So I think it's right. We are at different stages. Just like I showed that the investor, even we got 5 classes of investors. They comes in at different stages. So to have a business success is it's not a single success factor. We need a combination. So everybody will play a part to make the business a success. So I believe that all of us can play our parts together to help the business to grow. I mean, even between PIF and 𝗠𝑆ce Capital, we also have draw our line very clear. This is what you do, this is what we do. Yeah, you teach and you handhold. I do the execution of the IPO. So we are also very clear within a group. So I think we can all work together. Yeah.
Any last question? Okay. Thank you, everybody.